So, you've heard about ETFs, but getting started feels complicated, right? How do you begin? Which account do you need? And how do you set up a savings plan without messing it up? That's exactly what we're covering today, a clear step-by-step guide to ETF investing. By the end of this video, you'll know exactly what to do to start building long-term wealth. First things first, you need a brokerage account. Think of it as a digital safe for your investments, just like a checking account, but for holding securities instead of cash. Through your broker's app or website, you can buy and sell ETFs, check your portfolio, and collect dividends. In the US, you've got three main choices. First, traditional banks like Wells Fargo or Chase, they offer personal service, but they're usually more expensive, with higher fees. Second, online brokers like Fidelity or Charles Schwab, they offer a great balance of low costs, solid support, and a huge selection of ETFs, making them a fantastic choice for most people. Finally, there are app-based brokers like Robinhood or Webull. They're mobile-first, super user-friendly, and perfect for beginners who want to start quickly. So, which one is for you? If you prioritize low fees and a simple interface, a neo-broker is a great fit. If you want more research tools and customer service, a full-featured online broker is your best bet. The most important things to look for are no account maintenance fees, low or zero trading commissions, and a wide selection of ETFs. Opening an account is quick. It usually takes about 10 minutes online, and no, it won't affect your credit score. Once it's open, you just transfer some money from your bank, and you're ready to go. Alright, your account is set up. Now for the big question, which ETF should you actually buy? An ETF or exchange-traded fund is a single investment that tracks a market index, like the S&P 500 or the MSCI World. This means when you buy one ETF, you're instantly investing in hundreds or even thousands of companies across the globe without having to pick individual stocks. For example, an MSCI World ETF gives you a slice of about 1,500 companies from 23 developed countries. From Apple and Microsoft to Toyota, you're basically investing in the global economy itself. When choosing your ETF, there are a few key things to look at. First, diversification. Go for a fund that invests globally across different sectors. Broad indexes like the MSCI World or FTSE All World are perfect for beginners. Second, check the costs, specifically the expense ratio or TET. This should be low, ideally between 0.05% and 0.30%. These fees are taken out automatically, so you barely notice them. Next, consider the replication method. Physically replicated ETFs actually buy the stocks in the index, which is straightforward and great for beginners. Also, think about dividends. Accumulating ETFs automatically reinvest your dividends, which fuels compound growth. Distributing ETFs pay them out to you as cash. For long-term growth, accumulating is usually the way to go. If sustainability matters to you, look for ESG or SXE, which screen out industries like fossil fuels or weapons. Finally, stick with big, reputable providers like iShares, Vanguard, or Schwab. They manage billions and are very stable. Some solid, beginner-friendly ETFs are the iShares Core MSCI World for developed markets, the Vanguard FTSE All World for global exposure, or the SPDRS and P500 ETF, also known as SPY, if you want to focus on the US market. Honestly, don't get stuck trying to find the perfect one. The most important step is just to start. Once you've picked your ETF, it's time to make your first purchase. In your broker's app, just search for the ETF's ticker symbol like VTI and hit buy. Enter the amount you want to invest, say $500, and confirm the trade. The money will come from your account, and the ETF shares will appear in your portfolio. Here's a pro tip. Try to place your trades on weekdays between 10 a.m. and 4 p.m. Eastern Time. That's when markets are most active, and you'll typically get the best prices. After you buy, don't panic if the price moves up and down. That's totally normal. ETFs are for the long haul. We're talking 10, 20, or even 30 years. So please, resist the urge to check your app every day. Now for the secret weapon of smart investors, the automatic investment plan. This is the easiest way to build wealth consistently. You just set it up to invest a fixed amount automatically every month. This has huge advantages. First, you take the stress out of timing the market. By investing regularly, you buy more shares when prices are low and fewer when they're high. That's dollar cost averaging. Second, it builds discipline automatically. The plan runs on its own, so you don't have to think about it. And third, it unleashes the magic of compounding. Your regular contributions will create exponential growth over time. Setting it up is simple. In your broker's app, look for recurring investment or auto-invest. Pick your ETF, set a monthly amount. Even $50 is a great start, and choose a day for the transfer. The most important thing is building the habit of investing. A good rule of thumb is to aim for 10 to 20% of your net income, but start with whatever you're comfortable with. What about taxes? In the US, you'll pay capital gains tax when you sell for a profit and taxes on any dividends you receive. But here's the good news. ETFs are very tax efficient. You only pay tax when you sell or get paid a dividend. Plus, long-term gains are taxed at a lower rate. If you use a tax-advantaged account like a Roth IRA or a 401k, you can avoid or delay taxes completely. So don't let taxes scare you away from investing. Let's talk about some common mistakes to avoid. First, don't buy too many ETFs. 1 or 2 globally diversified funds are all you really need. Second, stop checking your portfolio all the time. It leads to emotional decisions. Look at it a few times a year, max. Third, don't try to time the market. Nobody can predict it. Consistency always wins. Fourth, never sell in a panic. Market drops are a normal part of investing. Staying invested is how you recover and grow. And finally, avoid high fees. Keep it simple with low-cost ETFs. Ultimately, investing is a mental game. The biggest challenge isn't the market. It's managing your own emotions. Create a routine. Invest automatically. Treat it like any other bill and trust the process. Over time, you'll see the magic happen as your money starts to grow on its own. That's the power of compounding at work. So let's quickly recap the 4 simple steps. 1. Open a low-cost brokerage account. 2. Choose a broad low-cost ETF. 3. Make your first investment to get started. And 4. Set up an automatic monthly investment plan. Then just be patient. Remember, successful investing is about time in the market, not timing the market. So, what's next? In our next video, we'll dive into your brokerage app and explain what things like limit orders, bid-ask spread, and other jargon actually mean, so you can feel even more confident. I really hope this video was helpful. If it was, please give it a thumbs up and subscribe to our channel. That way, you'll get all our new videos that make the world of finance easier to understand. Thanks for watching, and I'll see you in the next one.